They're presenting. We don't want to distract them in any way while they're up on stage. But please welcome at this time our third team this evening from Russia Higher School of Economics.
Just a second. Just a second, guys. Oh, jeez. 1 second, guys. Sorry.
Good afternoon, ladies and gentlemen. We are glad to be here today. My name is Vitaly. Our group of analysts from the Higher School of Economics is going to initiate the coverage of Magnit PGC with the hold recommendation for both local shares and GDRs. Magnit is the #1 Russian food retail chain with a strong cash flows that is currently operating in poor macroeconomic situation. Our target price on 31st of December 2016 is 12,000 rubles per share. The company is traded on the Moscow and London stock exchanges. Magnit is included in top indexes representing Russia that provides additional demand from passive investors. Our research showed the GDRs are trading at a premium of $6 to local shares. Now, let's talk about business overview. Magnit is the Russian food retail leader by number of stores, revenue, earnings, and market capitalization. The company operates more than 12,000 retail stores. Its multi-format business model comprises convenience stores, hypermarkets, Magnit family, and cosmetic stores, with the highest revenue generated by convenience formats and profitability by cosmetic stores. Company strategy is based on vertical integration. Magnit developed its own logistics system with its large fleet and warehouse space and efficient centralization strategy. Private label covers 11% of Magnit's revenue. Own production gives additional benefits for the company. Now let's move to the corporate governance and shareholder structure. In 2006, Magnit conducted its IPO and issued its GDRs in 2008. The free float of the company is 56%. The CEO, Sergei Galitsky, owns 35%. 11 members of the company's board of directors are known for a strong ethics and background, effective risk management, and long experience in Magnit. The CEO in the company itself won lots of corporate governance awards. Now, Vyacheslav will tell you about the current macroeconomic conditions.
The current macroeconomic conditions in Russia are challenging. There are two factors that have led to the recession. First, a fall in oil prices. Half of the national budget is provided by oil and gas revenues, which results in the Russian currency being dependent on oil prices. Second, economic sanctions. In March 2014, the United States and the European Union restricted access to Western capital market for some Russian companies. In response, Russian government imposed a food import ban that has contributed to high inflation. Fall in real wages have led to the decrease in Russian retail turnover, but recently we see signs of rebound. We expect the growth of real wages and retail sales of 2% starting from 2017. Speaking about industry trends, we believe modern retailers will continue crowding out traditional formats. Small urban areas where market share of modern retailers hovers around 30% are the main source for growth. Another trend is market consolidation. Today, The market share of the top 5 retailers in Russia is 20%, and it is expected to rise considerably. Despite economic crisis, federal retail chains plan to expand further, pushing out local retailers. Soon, a new law is expected to come into force. It consists of 2 initiatives: decreasing rebates, shortening payable periods. The former puts pressure on retailers' margins, while the latter results in one-off investment into working capital. But both amendments look manageable for the key players. Now Sofia will tell you about competitive positioning.
X5, Dixie, Lenta, and OK were selected as peer group companies. All the firms targets low-cost segment. Magnit became the leader with a market share of 7% due to its focus on the most rapidly growing format, convenience stores, with an average annual growth rate of 23%. Magnit, as opposed to the peers, targets small towns where it enjoys weak competition, as modern retail penetration there is very low. As these areas were strongly affected by the economic instability, Magnit experienced a slowdown in its like-for-like indicators. However, the company still achieves high sales growth by expanding its selling space. Last year, Magnit faced a slight decline in its like-for-like traffic, staying behind of X5 and Lenta, but ahead of Dixie and OK. Still, the company has very important advantages. Magnit is the only Russian food retailer developing cosmetic stores, which are the most profitable. Due to the logistics system, Magnit is able to reduce its distribution cost and achieve the level of direct supplies from the producers equal to 90%. Now, Magnit produces fresh vegetables constituting 1.5% of its total sales, which help to avoid the drawbacks of ruble depreciation. Within the next 5 years, it's going to invest 50 billion rubles into production of a wide range of goods to offer more beneficial prices to its customers. Now I'm passing the word to Vladimir, who will tell you about financial analysis.
Magnit's margins are the highest among the competitors. The high margins are explained by in-house innovative logistics, optimization of internal business processes, and strong bargaining power with suppliers. We expect Magnit's margins to decline in 2016 due to macroeconomic difficulties and possible price war in the industry. However, we see margins exceeding current level by 2020 because of the stabilizing situation in the economy, increasingly profitable cosmetic stores, and further development of private label program, including own production. Revenue growth of the company was derived mainly from the increasing number of convenience stores and hypermarkets. Recently, sales growth started to decline because of the falling real wages among the Russian population and higher competition in the industry. For the projected period, we conservatively forecast lower growth of revenue, driven by the slow increase in the number of stores, effect of a high base, and unfavorable macroeconomic conditions. Fast growth in the selling space required significant capital expenditures over the previous years. Consequently, the free cash flow of the company was negative until 2014. As recently opened stores become mature, they will provide significant cash return to cover investments into new stores, which are not expected to increase. In our opinion, Magnit is turning into a highly free cash flow generating company, seeking new investment opportunities for the further development of vertical integration and rewarding shareholders via increased dividend distribution. Now, Sergei will describe the results of the valuation.
We estimated Magnit target price using discounted cash flow valuation based on moderately conservative assumptions and ruble cash flows. Target price, derived from the intrinsic value, doesn't provide sufficient upside, and at the same time it doesn't apply a downside. We received a target price of 12,000 rubles per share and an upside of 16%. We also conducted a trading multiples analysis to benchmark Magnit's current market valuation against its peers. However, our analysis revealed the lack of reliable peers in Russia, mainly because of Magnit's unique developed business model and strong corporate governance. And the lack of international peers is mainly because of the differences in economic environment, country risks, and markets. Moving further from revenue and EBITDA projections, we estimated free cash flows to the firm with almost 55% of CAGR over the forecast period. We use WACC of 16.6% in the forecast period and 14.6% in the terminal period. We assume terminal growth rate of 6.4%. We also ran a Monte Carlo method with almost 10,000 simulations and 6 main variables, namely revenue growth rate, EBITDA margin, CAPEX, changes in working capital, WACC, and terminal growth rate. There is a 20% probability that the target price will fall below the current price. That supports our hold recommendation and general positive view. And now let's move further and discuss Magnit's major risks.
We have identified three main risks for Magnit. First, the company's peers, X5 and Lenta, actively compete in setting lower prices, which may create an incentive for Magnit to do the same. That will result in falling margins. Second, there is a possibility of a further decline in real disposable income of customers, which will lead to lower like-for-like sales. And finally, Magnit may not be able to find enough suppliers which will comply with the company's requirements of quality and purchasing prices.
To conclude, we initiate the coverage on PJSC Magnit with a hold recommendation, based on a target price of its ordinary shares, offering 16% upside from its closing price on the 8th of April 2016. With our recommendation takes into account that Magnit is a great business which operates in a turbulent macroeconomic environment. At the same time, current unpredictable market dynamics translates into a high level of uncertainty in the short-term behavior of Magnit stock. Our long-term view on the Magnit is positive and based on a fundamental analysis of the company's future development. Thank you for your attention.